Hey there, savvy investors. Iggy here, your trusty investing iguana, and boy, do I have a juicy story for you today. Brace yourselves because we're about to uncover the truth behind Frasers Property's massive selling spree. That's right, they've been offloading assets left and right to their REITs FCT, FLCT, and FHT. But here's the million-dollar question, is this a golden opportunity or a ticking time bomb for these REITs and their investors? Well, lucky for you, I've put on my detective hat and dug up all the dirt. And trust me, the plot thickens with every twist and turn. We've got FCT making power moves, FLCT expanding its empire, and FHT throwing a curveball that'll make your jaw drop. It's like a real-life drama unfolding in the world of REITs. But don't worry, I won't leave you hanging. I'm here to break it all down in a way that's so simple, even a high schooler could keep up. No jargon, no nonsense, just straight-up facts and insights that could make or break your investment game. So, if you're ready to get the inside scoop on this roller coaster ride of a story, buckle up and join me on this wild adventure. Grab your favorite snack, get cozy, and let's unravel this mystery together. Trust me, you won't want to miss a single moment of this thrilling tale. Let's dive deeper into the recent strategic moves by Frasers Centrepoint Trust, FCT. The company made a significant acquisition, increasing their stake in NEX Shopping Mall by an additional 24.5%. This purchase was made from their parent company, Frasers Property, and it has effectively doubled FCT's ownership in NEX to a substantial 50%. This is a noteworthy development for several reasons. Firstly, it's anticipated to enhance their distribution per unit, DPU, a key metric for real estate investment trusts, REITs, that indicates the payout received by investors. With this acquisition, FCT's DPU is projected to increase by an impressive 1.5%. For those who are new to investing, this essentially means that the income you could potentially earn from your investment in FCT is likely to grow. But what's truly remarkable is FCT's financial management throughout this process. Despite the sizable investment in NEX, FCT's gearing ratio, a measure of financial leverage that shows the proportion of the company's debt relative to its equity, actually decreased from 39.3% to 37.8%. This was achieved through strategic divestments, including the sale of Chinese Centrepoint and Hector REIT. Talk about financial finesse. Looking ahead, you might be curious about what other acquisition opportunities Frasers Centrepoint Trust, FCT, could potentially explore from its parent company, Frasers Property. At first glance, the options appear to be somewhat limited. One property that seems to align with FCT's investment strategy, which focuses on suburban malls, is Northpoint City South Wing. Northpoint City South Wing is a prominent retail destination that fits well with FCT's portfolio of suburban malls. However, it comes with a substantial price tag of $1.1 billion. In the current economic climate, where interest rates are high, this could significantly increase FCT's gearing ratio. The gearing ratio is a key financial metric that measures the proportion of a company's debt compared to its equity. A higher gearing ratio indicates a higher level of debt, which can increase the financial risk for the company and its investors. Therefore, while the acquisition of Northpoint City South Wing could potentially enhance FCT's portfolio, the associated increase in gearing could offset these benefits. In this context, it's important to consider the broader economic environment. With interest rates on the rise, the cost of borrowing is increasing. This means that the additional debt taken on to finance such a large acquisition could end up costing FCT more in interest payments, which could impact their profitability and, ultimately, the returns for investors. Therefore, while Northpoint City South Wing may seem like a good fit for FCT's portfolio, the timing of such a large acquisition could be less than ideal. It's a delicate balance between growth and financial stability, and FCT will need to carefully consider these factors when making their next move. Let's shift our focus to Frasers Logistics and AMP Commercial Trust, FLCT, another entity under the Frasers Property umbrella. They've been making strategic moves in the market as well, recently acquiring 4 fully occupied logistics properties located in Germany. The total cost of this acquisition was a substantial $188.9 million. This acquisition is a strategic one for FLCT for several reasons. Firstly, these properties are fully occupied, which means they are already generating rental income. This can contribute to a steady stream of revenue for FLCT, enhancing their financial performance. Secondly, these properties are located in Germany, a key market in the European logistics sector. By strengthening their presence in this market, FLCT is positioning itself to capitalize on the growth opportunities in the European logistics industry. This could potentially lead to increased profitability and returns for investors in the long run. Lastly, despite the size of this acquisition, FLCT has managed to maintain a healthy financial position. Their gearing ratio, which is a measure of the company's financial leverage, remained at a healthy 32.5% post-acquisition. This indicates that FLCT has managed to finance this acquisition while maintaining a balanced debt-to-equity ratio, which is a positive sign for their financial stability. Now, let's turn our attention to Frasers Hospitality Trust, FHT, which has proven to be quite the wild card in this scenario. They were recently presented with an offer from Frasers Property to acquire Capri by Fraser, a property located at Changi City. Interestingly, despite having the right of first refusal, FHT chose to decline this offer. This decision might seem surprising at first, especially considering the potential for growth that such an acquisition could bring. However, it's important to understand that FHT's management team is guided by a clear set of strategic goals. These goals are designed to ensure the long-term success and sustainability of the trust, and they are not necessarily focused on short-term growth alone. In this case, it appears that the acquisition of Capri by Fraser did not align with these strategic objectives. This could be due to a variety of factors, such as the property's location, its fit with FHT's existing portfolio, or the financial implications of the deal. What's particularly noteworthy here is FHT's willingness to say no to an opportunity for growth when it doesn't align with their strategic vision. This demonstrates a level of independence and strategic foresight that is crucial in the dynamic and competitive world of real estate investment. It shows that FHT's management is not simply chasing growth for its own sake, but is making calculated decisions that take into account the broader context and long-term implications. First off, let's address the elephant in the room. The majority owners of Frasers Property are considering selling the company or some of its assets as part of a strategic review. This is big news, folks. The Siravat-Hanabakti family, who control a whopping 87% of Frasers Property shares, seem to be looking to cut debt and optimize their portfolio. Now, this could go a couple of ways. On one hand, a potential sale could mean a cash injection and a chance for Frasers Property to streamline operations. It might even lead to a leaner, meaner company that's better positioned for growth. But on the flip side, there's always the risk of a messy transition or a less-than-ideal new owner. Plus, let's not forget that Frasers Property's been on a bit of a selling spree themselves, offloading assets to their REITs like FCT, FLCT, and FHT. While this has helped them manage their debt, it's also left some wondering about the quality of the assets being sold. Speaking of debt, that's another key factor to watch. Frasers Property's net gearing ratio hit 78% as of December 2023, which is pretty high. Sure, they've got a solid 2.4 billion Singapore dollars in pre-sold revenue, but that debt load is nothing to sneeze at, especially with interest rates on the rise. The bright side? Frasers Property seems to be making moves to shore up their balance sheet. They've been extending debt maturities and focusing on green and sustainable financing. Plus, they're sitting on some prime assets, like their residential projects in Singapore, Australia, and China. The property market is often likened to a roller coaster ride, filled with ups and downs, twists and turns. The year 2024 is shaping up to be no different. Several factors are poised to impact the market dynamics significantly. These include rising interest rates, disruptions in the supply chain, and the ever-present economic uncertainty that can introduce unexpected challenges. As an investor, navigating this complex landscape can seem daunting. However, the key to successful investing lies in staying informed and vigilant. It's crucial to monitor key indicators closely. This includes keeping an eye on interest rates, which can affect the cost of borrowing and, consequently, the profitability of real estate investments. In addition, it's important to track the debt levels of the companies in which you invest. For instance, keeping tabs on Frasers Property's debt levels can provide insights into their financial health and risk profile. High debt levels can increase a company's financial risk, which is something investors should be wary of. Furthermore, don't hesitate to scrutinize the quality of a company's assets and the strategy behind their investment moves. Asking tough questions can help you understand the company's growth potential and the risks involved. Frasers Property finds itself at a critical juncture in 2024. The potential sale by its majority owners could mark a significant turning point for the company. This could lead to changes in the company's strategic direction, management approach, or financial performance, which could have implications for investors. While Frasers Property boasts a strong portfolio of assets, it also carries a high debt load. This, coupled with the overall market uncertainty, means that investors will need to stay alert and responsive to changes. It's a delicate balancing act between seizing growth opportunities and managing risks. But with careful planning, diligent research, and a keen eye on market trends, investors can navigate these challenges and make informed decisions. All right, savvy investors, we've covered a lot of ground today. We've seen how Frasers Property's selling spree is shaking things up for FCT, FLCT, and FHT. Some smart moves, some surprising twists, and a whole lot of potential for growth, but also a few red flags to watch out for. The key takeaway? As investors, we can't just sit back and watch. We've got to put on our thinking caps, crunch the numbers, and make sure these REITs are making moves that will pay off in the long run. And that's where your buddy Iggy comes in. I'm here to help you navigate these tricky waters and make smart plays with your hard-earned cash. So, if you found this video helpful, show me some love by smashing that like button and subscribing to the Investing Iguana channel. And hey, while you're at it, share this video with a friend who could use a little investing wisdom. Together, we'll keep sharpening our financial claws and building the wealth we deserve. Until next time, stay savvy, my friends.